All right, if you've got money sitting in a 401k or a traditional IRA, we really need to talk. There's a specific rule you absolutely have to understand because, honestly, messing it up can be extremely expensive. It's called a required minimum distribution, or RMD for short. In this video, we're going to break down exactly what RMDs are, go through the big new rule changes that have everyone confused, and most importantly, show you how to get out in front of them. Now, calling it a tax bomb might sound a little over the top, right? But it's actually a pretty accurate description. Think about it. You've done everything you were supposed to do. You've saved for years. You've watched your nest egg grow, all while your taxes were deferred. But here's the twist. The government has been quietly waiting the whole time for its share. An RMD is the spark that can set that whole thing off. So let's talk about how to disarm it. All right, so what is an RMD exactly? At its core, it's the moment Uncle Sam finally steps in to collect on a very long-standing IOU. Let's be crystal clear about this. The key word is required. This isn't a suggestion. It is not optional. Consider this. For decades, your money inside that traditional IRA or 401k was growing and compounding, and you weren't handing over a penny of tax on that growth. It was a great arrangement, but there was never a world where the IRS was going to let that pile just sit there untouched forever. An RMD is simply the government's way of saying, all right, the clock has run out. You need to start drawing some of that money out. And now we're going to tax it. And this quote really sums the whole thing up, doesn't it? This is the entire idea in one simple phrase. Every contribution you made and every bit of growth your investments produced was part of a deal. You got the tax break up front, and the government reserved the right to tax it down the road. The RMD is just the invoice finally landing in your lap. So that's the what, we've got that down. Now let's move on to the when. And this, my friends, is where things have become really, really complicated lately. It's honestly where a lot of people are stumbling because the rules have changed and the fallout from getting it wrong, well, it's as serious as it's ever been. For a long time, you probably heard about that magic age, 70 and a half. That was the standard age for years. Then it was bumped up to age 72. And just when everyone adjusted and thought they had it figured out, boom, the Secure 2.0 Act came along and reshuffled the deck again. Now we've got an entirely new structure for figuring out when your RMDs have to start. Okay, hit pause for a second and really take a careful look at this chart. What you're seeing here is the most crucial part of your whole planning process. The logic behind it is actually pretty straightforward. If your birth year is before 1960, your RMDs must start at age 73. That's it. If you were born in 1960 or later, you get a bit more breathing room. Your start age is 75. Find your birth year on this chart and lock that number into your mind. That age sets your entire RMD schedule. So, what if you miss it? What if life gets busy, you overlook it, or you misjudge the date? The fallout is no joke. This is what a lot of financial professionals call the penalty trap. And believe me, it's a trap you really don't want to stumble into. 25%. Just let that percentage sit with you for a second. This isn't a tiny little fee. It's one of the biggest, harshest penalties the IRS can hit an individual with, and it often happens because of a simple mistake. And here's the crazy part. This is actually better than it used to be. The penalty used to be a staggering 50%. Yes, 50. So 25% is the reduced rate. How does this work in practice? It's not a penalty on the full balance of your account, thankfully, but it is a 25% hit on the amount you were required to withdraw for that year but failed to take out. Let's plug in some numbers so you can see just how big this can get. Let's say you did an amazing job saving. You've accumulated a $1 million IRA. That's a huge milestone. According to the IRS life expectancy tables, your required withdrawal for the year might land around $42,000. If you forget to withdraw that money, if you simply miss the deadline, you don't just owe the regular income tax on that amount. The IRS tax on an extra penalty of $10,500. That's more than 10 grand gone because of 1 year's oversight. Calling that painful doesn't even begin to cover it. Now, I know that sounds alarming, and honestly, it is. But here's the single most important thing I'll say about this penalty. It is entirely, completely, 100% avoidable. It never has to happen to you. The goal isn't to scare you. The goal is to let that penalty motivate you to put a plan in place ahead of time. This is about stepping into the driver's seat. All right, let's move away from the scary stuff. We've defined this tax bomb. We've identified the trigger. We've seen how nasty the penalty can get. Now let's pivot to the good news. Let's talk about how to actually neutralize it. The best part is you don't have to just sit there and hope for the best. You can absolutely take charge of this situation and deliberately shape the tax outcome using some smart planning strategies. So, to quickly summarize why we call it a bomb in the first place, it's because RMDs create taxable income that you may not even want or need, and that extra income sets off a chain reaction. First, it can shove you into a higher tax bracket than you ever planned for. Second, and this is the part people routinely overlook, it can cause a bigger portion of your Social Security benefits to become taxable. It's a triple hit to your retirement picture. The most powerful tool for diffusing this bomb is, without question, the Roth conversion. The strategy is almost elegant in how straightforward it is. Rather than waiting for the government to force withdrawals from your IRA in your 70s, you decide to move some of that money out earlier on your own terms. You pay the tax on that amount now at today's rates and transfer those dollars into a Roth IRA. The real magic here lies in timing. A lot of retirees have this golden window in the early years of retirement, after they've stopped working but before Social Security and RMDs begin. During those lower income years, you can convert slices of your IRA, intentionally filling up the lower tax brackets. Once that money sits inside the Roth, it grows totally tax-free. And here's the knockout blow. Roth IRAs carry no RMDs for the original owner. You've essentially taken a looming tax bill and transformed it into an incredibly valuable tax-free resource. All right, Roth conversions are fantastic, but what if you're already passionate about giving to charity? In that case, there's another powerful option at your fingertips. It's called a qualified charitable distribution, or QCD, and it comes with a very special tax benefit. This bar chart is a perfect visual for how effective a QCD can be. Let's go back to that $42,000 RMD example. If you handle it the typical way, as shown in that first bar, you simply add $42,000 of taxable income to your return. Straightforward enough. But with a QCD, you direct your IRA custodian to send that same $42,000 straight to an eligible charity. The funds never land in your personal account. Because of that, the amount never even shows up as income on your tax return. Now look at that second bar. Zero increase in taxable income. It's remarkable. You still fully meet your RMD obligation, but your reported income doesn't climb at all. It's a genuine win-win. You're supporting a charitable cause that matters to you, while satisfying the IRS in the most tax-savvy way available. So, we've walked through the what, the when, and the how. We've covered the issue and we've outlined some seriously effective solutions. But here's the thing. Knowledge alone doesn't change anything, right? So let's turn this into a real action plan, something practical that lets you convert all this information into concrete steps. Here's a straightforward 4-step roadmap to stay ahead of the curve. Step 1. Map out your future income. Include everything. Estimate your Social Security, any pensions, rental properties, all of it. Step 2. Approximate your RMDs. They don't have to be perfect. Just get a reasonable estimate. There are plenty of easy online calculators for this. Step 3. Pinpoint the risk. This is the crucial piece. Add your projected RMD to your other income sources, and then look at where that total lands in the tax brackets. Does that higher number push you into a level you're not comfortable with? And finally, Step 4. Use that insight to evaluate your options. Once you see the full picture, you'll know whether it makes sense to start managing your tax bracket through Roth conversions, or whether a QCD approach lines up better with your goals and values. And that's really what all of this boils down to. It comes down to one simple but absolutely vital question, because these required withdrawals aren't some small technical detail you can deal with at the last minute. They are a major central element of your retirement strategy. If you ignore them, you're effectively handing the steering wheel of your financial future over to the IRS. But if you plan around them, if you act early and thoughtfully, then you're the one driving, protecting the retirement you spent so many years working and saving for.